Okay, what's up, everybody? This is Sun Ho, the Korean Bro. Today is 2024, May 7th. Let's see, okay? Meet the two beat Nasdaq 100 stocks over the past year. They soared 164%, 219%. And Wall Street says both stocks are still buys. Nvidia and CrowdStrike. Let's look at CrowdStrike holdings. Cybersecurity software vendor CrowdStrike looked strong in the fourth quarter. Revenue increased 33% to $845 million, and non-GAAP net income more than doubled to $236 million. Management expects that momentum to continue in the coming quarters. In fact, CrowdStrike is one of only three publicly traded enterprise software companies projecting 30% revenue growth this year, according to Morgan Stanley. CrowdStrike is the market leader in the endpoint security software. Recent data from the International Data Court suggests the company is also gaining share more quickly than its competition. CrowdStrike's success in endpoint security systems from what management believes is the most effective artificial intelligence and most easily deployed cybersecurity software on the market, and bodes well for shareholders for two reasons. First, endpoint security is one of the fastest growing product categories in the cybersecurity software market, meaning CrowdStrike has a powerful tailwind at its back. Second, the brand authority the company has cultivating endpoint security is driving share gains in other product categories, including identity protection, cloud security, and security information event management. Additionally, during the most recent earnings call, management mentioned early momentum with new data protection and IT automation software modules, excitement surrounding its new generative AI system, Charlotte AI. Those products expand CrowdStrike's addressable market and further solidify its position as a vendor consolidator. To elaborate, many enterprises deploy north of 60 cybersecurity point products, but CrowdStrike reduces complexity by letting enterprises eliminate point products and consolidate on a single platform. Okay, let's read a book tonight. Tonight, what I'm going to read is 42, page 42. All these factors turn small stocks into momentary bargains. When the tech-driven selling ceases in January, they typically bounce back, producing a robust and rapid gain. The January effect has not withered away, it has weakened. According to finance professor William Schwartz of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 to through 2001. As more people learn about the January effect, more traders bought small stocks in December, making them less of a bargain and thus reducing their returns. Also, the January effect is biggest among the smaller stocks. But according to Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can run up to 8% of your investment. Sadly, by the time you're done paying your broker, all your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O. Shinsey published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim from 1954 through 1994. You could have turned $10,000 into 8074 504, beating the market by more than tenfold, a towering 18.2% average annual return. How? By buying a basket of 50 stocks with the highest 1 year returns, 5 straight years of rising earnings and share prices less than 1.5 times their corporate revenues. As if he were the Edison of Wall Street, O'Shaughnessy obtained U.S. patent number 5,978,778 for his automated strategies and launched a group of four mutual funds based on his findings. By late 1990, 90 funds has sucked in more than $175 million from the public. In his annual letter to shareholders, O'Shaughnessy stated grandly as always, I hope that together we can reach our long-term goals by staying the course and sticking with our time-tested investment strategies. Hmm. But what works on Wall Street stopped working right after O'Shaughnessy publicized it. As Figure 1 2 shows, two of his funds stank so badly that they shut down in early 2000, and the overall stock market, as measured by the S&P 500 index, um, walloped every Shaughnessy fund almost non-stop for nearly 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with those time-tested investment strategies. O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title, for instance, What Used to Work on Wall Street Until I Wrote This Book. Follow the Foolish Four. In the mid 1990s, the Motley Fool website hyped the daylights out of a technique called the Foolish Four. According to Motley Fool, you would have trashed the market average over the last 25 years and could crush your mutual funds by spending only 15 minutes a year on planning your investments. Best of all, this technique had minimal risk. All you need to do was this: take the five stocks in Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. Discard the one with the lowest price. Put 40% of your money in the stock with the second lowest price. Put 20% in each of three remaining stocks. 1 year later, sold the dough the same way and reset the portfolio according to steps 1 through 4. Repeat until wealthy. Over a 25-year period, the Motley Fool claimed this technique would have beaten the market by a remarkable 10.1 percentage points annually. Over the next 2 decades, they suggested $20,000 invested in the Foolish Fool should flower into 1,791,000. And they claim you could do still better by picking the five those stocks with the highest ratio of dividend yield to the square root of stock price, dropping the one that scored the highest and buying the next four. Let's consider whether this strategy could meet Graham's definitions of an investment. What kind of thorough analysis could justify discarding the stock with the single most attractive price and dividend, but keeping the score lower for those desirable qualities? How could putting 40% of your money into only one stock be a minimal risk? How could a portfolio of only four stocks be diversified enough to provide safety of principle?